Hello, everybody. This is Professor Lambert on Business Valuation of Privately Held Companies, lesson number 4. This is a relatively short slide deck. This is our only slide for this lesson, but the material is voluminous and really important. You'll recall that in our valuation report, we had 4 primary sections, and the financial analysis, financial risk assessment is one entire section. So this is where we get very quantitative in our valuation. We talk about the numbers, all the accounting reports, and we synthesize that into a assessment of financial risk of our company. We're going to be analyzing the company over 3 key types of metrics. Profitability, does the company make or lose money and how much? Leverage, which is, does the company have its ability to pay its short-term and long-term debts? And also, does the company have the ability to service its interest expense? And also liquidity. Does the company have enough cash to meet its day-to-day operating needs? So we're going to look at the financials of our specific company. So this is a little bit different than our economic analysis, where we looked at the macroeconomy, the microeconomy, the regional economy, Porter's 5 forces, and a SWOT analysis, and this synthesized all that information into an overall economic outlook for our company. What we're doing now is we're looking at the specific financial position of our company in terms of its ability to make money and also its ability to analyze its assets, liabilities, and equity. So we could have a company that is operating in an economic environment where the economy is growing, interest rates are low, and inflation is low, but our company is still suffering. So our company's financial position is not great. Also, we can have the complete opposite. We can have a time when the economic condition of the country is poor, the economy isn't great, GDP is not growing, inflation is high, interest rates are high, and yet our company is thriving because of what it does specifically. And we can talk about some examples of those types of businesses. Everyone is, again, facts and circumstances dependent. So when we look at a company's financial statement, we're starting with its revenue and its expenses. And remember that we've asked our client for 5 years of historical financial statements. So we should at least have the ability to create an income statement and a balance sheet, even if we only have tax returns for our client, rather than the best financial statements are audited ones. They've been examined for GAAP and so on and so forth. But for most privately held businesses, we get tax returns. We can still generate an income statement and balance sheet. And the way our financial analysis and risk assessment can start is to look at the revenue and net income of our company and discuss what those items are in dollars. So for instance, if I say our company had revenue of $20 million and net income of $2 million, you immediately have a way to understand the size of the company. If I told you a company had $2 billion of revenue and $500 million of net income, well, that tells you it's a giant company as well. And I can also tell you a company only has $1 million of revenue and made $50,000 of net income. So all of those big picture things tell us something really important about our company. How big is its revenue, the goods and services it's selling to its customers, and did it make money or lose money, and how much? The next thing we want to do is look at our company's assets, liabilities, and equity and analyze those in dollars as well. What is the size of our company's balance sheet? Does it have 10 million of assets, 100 million, billions of dollars, or is it only like $100,000 asset type of balance sheet? Likewise, we can analyze liabilities and equity as well. So for instance, we could have a $10 million asset company that has 3 million of liabilities and 7 million of equity. That tells us something. It doesn't have a ton of liabilities relative to its asset base. By the same token, I can also say, well, I have a company that's got 10 million of assets, $13 million of liabilities, and negative $3 million of equity. Well, that tells you something also very important, that the company even has more liabilities than assets. That can be a company that's in trouble or at risk of going bankrupt. So again, those are the two ways we want to start at a very high level: revenue, net income, assets, liabilities, and equity. Then we get into the more sophisticated types of analyses that we started learning about in Accounting 102, and that would be common-sized income statements and common-sized balance sheet. Now I'm going to highlight a few things on this slide. I do have that listed twice, common-sized income statement and balance sheet, but I'm distinguishing between the company's historical income statement and balance sheets as opposed to its projections. If we have both of these for a company, history and projections, we're going to analyze both. But we're always going to start with history. What did the company actually make or lose in terms of money? What assets, liabilities, and equity did the company actually have over the prior 5 years? And if you remember what common sizing was, or what it means, it's a way of putting everything in a proportional sense of a company for its income statement and balance sheet. For example, a common-sized income statement means we take every line item on the income statement for a company for a particular year and divide it by the revenue for that year. What that does is that puts everything for that year as a percentage of revenue. And if you look in the Excel sheet that I'm including with this teaching of valuation, you will see a common size income statement for you. I've already generated that for you. All you have to do is analyze it. When we look at a company's balance sheet, we divide every line item on the balance sheet by total assets. So whether they're assets, liabilities, or equity, we're always dividing every one of those individual line items by the company's total assets. So cash divided by total assets, accounts receivable divided by total assets, and so on. And that puts everything in a common-sized perspective for us, which allows us to compare our company to other companies. For instance, if I was a coffee business and I wanted to compare myself to Starbucks, I can also create a common-sized income statement and balance sheet for Starbucks and see how do my percentages compare to those of Starbucks. Am I as percentage profitable as Starbucks? Is my my balance sheet, do I have is cash, like as a percentage of my total assets, higher than Starbucks, the same, or lower? And that can tell me information about financial risk. As I've said, you also want to do this for projections as well. If a company shows you projections where the common-sized income statement and balance sheet percentages are radically different than the past, you want to be asking why. That's true of projections in general. If a company is making $10 million a year of revenue and about $1 million of net income, and then their projections now show them going up to $50 million in revenue and tens of millions of dollars in net income, you want to ask yourself why. Because a projection is just an educated guess about the future. Now, in some cases, some companies do very detailed projections, and it's a very educated guess. And other times, it's fairly unsophisticated and not as deep. So again, common sizing income statements and balance sheets are really important, and that helps us with our horizontal and vertical analysis of a company's financial statements. If you remember, horizontal was looking at 1 year compared to a prior year, and vertical tended to look at things in a common size standpoint like we've been discussing. The other key part of the financial analysis section of the valuation is a ratio analysis. And this is something where we have a lot of ratios to look at in a valuation. And those ratios are related to those same categories that we discussed: profitability, leverage, and liquidity. And what we're going to be doing in our valuation analysis is crunching those numbers, looking at those ratios, and deciding whether our company, we're going to compare our company's ratios to the industry as a whole, or maybe to some specific companies in our industry, and make an assessment. Is that ratio stronger than the industry? Is it about the same as the industry, or are we weaker than the industry? Now you have to remember this about ratios. Sometimes having a high ratio means your company is strong. Sometimes having a low ratio means your company is strong. So you always have to understand the specific ratio that you're calculating and understand whether higher is better or worse, meaning stronger or weaker. I'll give you one example. We can look at the current ratio, which is current assets divided by current liabilities. Current assets are those assets that are expected to be used up within a year or be converted into cash within a year. And current liabilities are those amounts the company expects to have to pay within a year. So some big current assets are inventory and accounts receivable. We expect to sell our inventory within a year, and if we have accounts receivable, we expect to collect that cash within a year. Accounts payable is for things that we've purchased, and we are going to be paying our accounts payable within a year. So the current ratio, which takes current assets divided by current liabilities, we immediately get some useful information from this ratio. If this ratio is greater than 1, it means our current assets divided by current liabilities. If the ratio is greater than 1, that means our current assets are higher than our current liabilities. We expect to collect more cash in the next year than we expect to have to pay in the next year. So a current ratio of greater than 1 is usually a good thing. And for different industries, sometimes that ratio is more normalized at 2 or some other number. And I'll talk more about where we can get information to analyze our ratios relative to other companies in our industry. If our current ratio was around 1, around equal to 1, it means we expect to collect the same amount of cash that we're going to pay out in the next year, which is okay, but not great. And if our current ratio is less than 1, that means we expect to collect less cash in the next 1 year than we have to pay out in the next year. And that's creating a red flag situation where there could be more risk there because we're not going to collect as much cash that we have to pay out in the next year. So what does that mean for our company? Will we come up short and not be able to pay some of our operating type of expenses? So again, this is another part of the valuation where we're in the details, and yet we have to pull back in the big picture as well. We're in the details when we crunch the numbers and do our ratio analysis, but then we have to pull back to the big picture to make our final assessment of financial risk. Is our company more risky than the typical company that operates in our industry? Are we less risky than the typical company that operates in our industry? Or are we about as risky? And again, why is risk important? Financial risk, because that goes into our calculus of value as well. That's it for this lesson. I hope you found this useful.